You've probably heard of the 4% safe withdrawal rate, and if you've clicked on this video, you're probably already aware that today we recognize that 4% is only a rough guideline. The Vanguard group began promoting a more dynamic retirement spending or decumulation strategy around 2015 to 2020. Here's an example publication from 2017 that you can still find online. How does dynamic spending or decumulation in retirement work? In this video, I'll provide an example, but first let me explain some basic principles. Most retirees' portfolios fluctuate in value from year to year. Some years the markets are up, some years the markets are down. With a dynamic spending strategy, a retiree adjusts their spending from year to year so that they don't threaten their portfolio too much, but they also don't have to dramatically adjust their spending. For example, in this publication, Vanguard describes that no matter how much markets may be up in a given year, a retiree should commit to increasing their annual spending by no more than 5%. We can call 5% the increase ceiling. Again, this means that even if your portfolio is up, say 6% or 8% for the year, you will not raise your spending by more than 5%. And if your portfolio is only up 2% in value, you will raise your annual spending just 2%. What about when markets are down? A retiree should decrease their annual spending up to 2.5%. There's certainly no requirement that Vanguard's decrease floor is followed exactly, but if it is followed, it's comforting to know that even if your portfolio is down 4% or 8% or 10% since the prior year, you'll only have to decrease your annual spending up to 2.5%. And if your portfolio value is only down 1%, you would only decrease your annual spending by 1%. Keep in mind that the 5% ceiling and 2.5% floor are guidelines you can adjust according to your preferences. If you do adjust, what might be most important for protecting your portfolio is how you adjust your spending when markets are down. I'll return to that point later. Let's now look at an example of dynamic decumulation. So here we are in the first year of retirement. For simplicity, we're going to pretend throughout the example that there is no inflation. So keep that in mind if the dollar amounts seem a little bit disappointing. If you want to create your own example with inflation, then you can just adjust the dollar amounts according to what you think is a reasonable inflation estimate. Also, for simplicity, we're going to assume that this retiree has a portfolio value of $1 million at the time that they retire. After careful study, this retiree feels comfortable starting with a 4% withdrawal or decumulation rate. That's a personal decision based on what a retiree might read about the 4% withdrawal rate. They may be taking into account that they may have a little side income, or they may be expecting Social Security to help. And as they consider all of the facts, this retiree decides on a 4% withdrawal rate for the first year. Other people may decide that 3.5% is more prudent, or 4.5% is fine. So that means that this retiree plans on spending $40,000 in their first year of retirement. This retiree has also read about dynamic spending and has established an increase ceiling of 5% and a decrease floor of 2.5%. They have probably read Vanguard's publications on the matter. It's worth emphasizing that in year one, there's no dynamic spending happening. The retiree simply decides, according to their preferences, how much they are going to spend in their first year of retirement. It's then in year two and subsequent years that dynamic spending comes into play. Okay, so first example of dynamic spending. Let's move along to year two. What has happened in year two? Well, remember, over the last 12 months, this retiree has spent $40,000. And the markets have gone up. So now the retiree's portfolio value is $1,010,000, even though they spent $40,000 over the last 12 months. Now, if this retiree just computed 4% of their portfolio value of $1,010,000, they end up with $40,400. This is one possibility of what they could spend in year two of retirement. That's why we call it the proposed withdrawal amount, $40,400. But with a dynamic spending strategy, the question is that a safe amount to withdraw? Is that an appropriate amount to withdraw? Now, the markets have been up over the last 12 months compared to 12 months ago. The retiree now has $1,010,000 instead of $1 million. So we're going to look at the increase ceiling. The increase ceiling. This is computed by adding 5% more than was spent last year. Okay, the increase ceiling depends on what was spent last year, and we add 5% to what was spent last year. What was spent last year? $40,000. Add 5% to $40,000, and the increase ceiling is $42,000. Okay, so now the retiree has competing possibilities. They can either spend $40,400, which is 4% of the portfolio value, or they can spend the ceiling $42,000. Under a dynamic spending strategy, the retiree is going to spend the more careful, cautious amount of $40,400 because it is below this ceiling of $42,000. Okay, the decreased floor has also been computed, but this year it's not relevant because the portfolio value is up. So the retiree decides to stick with the proposed withdrawal, $40,400, because it's a little bit lower than the increase ceiling of $42,000. I hope that example helps, but now let's move on to year three so that we can see one more example. Well, unfortunately, there's been a bit of bad luck, as will happen from time to time. The portfolio value is down. It's now down to $929,000. When the retiree computes 4% of $929,000, the retiree sees an amount of $37,160. Now that's quite disappointing. Last year, they got to spend $40,400. Now, they're entertaining the possibility of spending only $37,160. That's a notable cut. However, in years when the portfolio value is down, the retiree also needs to look at the decrease floor. So when the decrease floor is computed, we get an amount that is a little bit less extreme. We get $39,390 versus $37,160. Now, again, how did that decreased floor get computed? Well, we looked at last year's spending. Last year's spending was $40,400. 2.5% less than $40,400 that was spent last year is $39,390. So this proposed withdrawal, it feels a little bit drastic, and it's not necessary for the retiree to cut their spending that much because the decreased floor is $39,390, which is more comfortable than cutting to $37,160. So this retiree, using the dynamic spending strategy and the percentages mentioned by Vanguard, this retiree could choose to use the floor value, $39,390, because it's not as extreme as the proposed withdrawal. Okay, I hope this is starting to feel familiar, but we've got one more example now. What happens in year 4? In year 4, good luck has returned in spite of the retiree's spending from last year. Thanks to the markets being up, the portfolio value has now increased to $1,180,000. When the retiree computes 4% of this amount, $1,180,000, they get the number $47,200, which sounds like a pretty exciting increase in possible spending. But this retiree is committed to the dynamic spending strategy, and they know that they have to compare $47,200 to the increase ceiling so that they don't overspend. And why are we looking at the increase ceiling? Because the portfolio value is up. So the increase ceiling, which is 5% more than the retiree spent last year, is $41,370. So apologies to the retiree, but if they stick to their rules, they will not get to spend $47,200. It's too much. They get to spend $41,370. This retiree is going to use the increased ceiling because the portfolio value is up, and the increased ceiling is not as extreme as the proposed withdrawal amount of $47,200. Okay, so I hope that helps. You can certainly pause and rewind, but let me point out one thing. Some of you may be looking at these numbers and feeling a little bit disappointed that over the years the amount doesn't go up more. Well, remember, for simplicity, we have removed inflation in this chart. So with dynamic spending, we have these tight parameters around how much we can increase or decrease our spending each year. With this small amount of flexibility and also strong restraint, we can ensure that the portfolio stays healthy for a very long time. Finally, let me share a key quote and idea with you if you're thinking about adjusting the strategy. It says in the Vanguard document that I showed you earlier, in fact, retirees' ability to accept changes in their floor helps their portfolio more than increasing their ceiling hurts it. In other words, what is most important to the health of the portfolio in the long run is what retirees do when their portfolio value has declined. If you're going to adjust the dynamic spending strategy, perhaps use different percentages, remember to focus most on spending less in years when the portfolio's value is down. Now, this general idea of the power of reducing spending when a portfolio's value is down happens to be consistent with an intriguing article that you can find on Michael Kitsis's website. This article is a guest post by Derek Tharp. Dr. Tharp emphasizes how powerfully a portfolio can be helped by permanently cutting spending by 3% in response to a drop in the portfolio's value. Tharp does not ignore inflation like I did in my example, and 3% is quite close to a cost of living adjustment. So a rough conclusion that we can draw from Dr. Tharp's analysis is that when markets disappoint, Retirees can substantially benefit from foregoing a cost of living adjustment, as long as they don't try to restore that skipped adjustment later. It has to be permanent. So I recommend this blog post to you for further details because it's reasonably consistent with what Vanguard has described.